Hey traders, welcome back to the channel. In today's video, we're diving into a crucial concept in Forex that's often misunderstood. And I'm talking about liquidity. I will break it down for you in under 5 minutes, so make sure to stick around to the end of this video. Okay, first off, what is liquidity? In Forex, liquidity refers to how easily a currency pair can be bought or sold without causing a significant change in its price. I mean, the more liquid the market is, the smoother the price action. And this usually happens during peak trading hours, when there are more participants in the market. For example, major currency pairs like euro dollar or pound dollar are highly liquid, while exotic pairs may have lower liquidity, making them riskier to trade. How to spot liquidity on the chart? Well, it most often appears around ranging markets, or basically when price is moving sideways without a clear direction, as you can see on my screen. Now, you can place your resistance level across the equal highs, and you can place your support level down here at the lows. We also know that there's plenty of stop loss and pending orders above and below those levels, because we've got breakout and retest traders who want to be triggered in the market. And this is what we call liquidity pools, when we have plenty of orders sitting within the same area waiting to be triggered. Now, as you can see, the market breaks above that resistance, it enters that liquidity pool right here, gathers all that liquidity and quickly sends price all the way down to retest previous lows. But because we've got another liquidity pool down here, the market needs to grab that as well in order to create this massive momentum move to the upside, sending price action all the way back to previous highs. And in order for these momentum moves to happen in the market, they need to gather liquidity, which often sits above and below ranging markets. Another way to identify liquidity on the chart is by looking at long rejection wicks in price. You can see after the market grabbed all that liquidity sitting below the equal lows right here, it printed out those rejection wicks, giving us a signal that it's probably going to reverse, as it doesn't have any more bearish momentum to continue pushing down. And this is exactly what happened. Now, this is something that we can use for our entry signals. But how do we actually trade liquidity in the market, and how do we take advantage of that thing? Well, first you need to know that trading with the trend is the best option, and also looking for rejection wicks, something that we talked about just a minute ago. Now, as you can see, I've got my support level right here, and we've got those equal lows, and we already know that there is a liquidity pool sitting right below that support level. Now, the market is still trading around those lows, and as you can see, we've already tapped into that support. And not only that, but we've also got this long rejection wick. We basically gathered all that liquidity sitting below those equal lows. Now, looking at the very next candle, the first thing we see is that it closes above the previous candle, and there's also another rejection wick as well. And I'm going to use this as my entry signal. My stop loss will go right below this rejection wick right here, and I'm going to be targeting the previous highs. Okay. And as you can see, we've got a 1 to 3.5 risk to reward ratio. Now, if you do this right, those trades will give you a really good risk to reward ratio every time you take an entry. Here is another great example of how well liquidity works in the market. I've got the resistance level placed up here on this previous high. You can see every time price tries to push above this resistance, it only gives you a long rejection wick without being able to close above that level. So this is a strong signal that you can expect a push to the downside. Then we have another pullback, and price again tries to break above that level, but couldn't manage to close above it. Instead of that, you get another rejection wick. So this is another signal for another sell entry. Now, the next time we try and break above that level, again, the only thing we see is some rejection wicks, and then what follows next is price pushing to the downside. So look for those signals in price action and know what's going to happen in order to know in which direction you should be trading. And there you have it. Forex liquidity explained in under 5 minutes. I hope this quick breakdown helped you understand how to identify liquidity in the market and how to trade it more effectively. If you found this video helpful, make sure to hit that like button and leave a comment down below as well. And don't forget to check out all the links in the description of this video. I'll see you next time.